Well, it was another fun day on Wall Street. Of course, big news overnight was Facebook just getting absolutely clobbered. The worst one-day market cap drop in the history of the stock market. Sounds pretty dramatic, but it was a big deal. And of course, that sent tech stocks lower. The NASDAQ was down by about 1%, but strangely enough, the Dow Jones was actually up today. So kind of some interesting action taking place on both the bullish and the bearish side of the equation here today. So we're going to take a look at what that all means. Amazon comes out with earnings here tonight. They just released their numbers here a moment ago, and that stock crushed estimates by more than 100%. The estimates were 2.5. They came in at $5.07. So that stock is up after hours, and hopefully that'll settle the markets down a little bit here for us. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 26th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you here in our audience. Remember, you can subscribe to our YouTube channel and also check out our description area on YouTube. That'll allow you to sign up for our email distribution list. In addition to that, we're also heavy users of Twitter. I was going back and forth with you today on a number of things on Twitter, especially Hershey's, a big day for Hershey's. So thanks to all of you guys that were supporting my article that I mentioned the other day on See It Market. That worked out pretty nicely. But anyway, I am on Twitter a lot, so is David. And so if you're looking for that social platform to kind of associate with us and kind of learn from our perspective some interesting ideas in the stock market, make sure you're following us. My handle is @BrandonVanZ. In addition to Twitter, we're also on Facebook. You can see our group web address on the logo in front of you, so feel free to join us there as well. All right, let's go ahead and dive into the analysis of the markets here today. As you can see, I've got the 4 grid pulled up in front of us here. This is chart 4B for those of you that are following along at home. And this will show us the 4 different major indices in the United States and give us a sense of whether they have bearish postures or bullish postures, basically from the market forecast perspective. Remember, the market forecast is a technical indicator that you can find within the Thinkorswim platform that has a green, a red, and a blue line embedded in it. And what we use to set our posture is the green line. That's the intermediate term line. And the way that we've got this chart set up here is the background colors of the chart will tell you whether we have a bullish or bearish posture to make it nice and easy visually for our eyes to determine that without too much effort. So as you can see, all of these charts do have a bullish posture as it stands, except for Russell 2000. Notice the Russell 2000 down here does have that pink shading taking place here, and so that does show a weekly bearish posture. However, the Russell 2000 actually had a very good day. You know, the Russell 2000 was up 0.6% today, and like I've been mentioning the last 2 days as I've been doing these videos, you know, don't write the Russell 2000 off yet just simply because you have a bearish posture change. When we're still trading above a rising moving average, that's a good sign there from just a purely price perspective. So right now there's some elements of bearishness, some elements of bullishness, and that's why we're going to focus on that particular instrument when we get into our trade application here in a little bit. But the point being, it was a nice day there out of the Russell 2000, bounce higher. If we can get another couple of days of bouncing higher, we should revert back to that bullish posture there. But otherwise, I think, you know, some of the takeaways from today are, first of all, the Dow Jones all of a sudden is starting to start looking attractive again. You know, it's been a while since we said that, since the Dow was our lagging index for much of the last several months. But take a look at the Dow. We're at multi-month highs there on the Dow now all of a sudden. We're clearly trading above a rising moving average. That's why that moving average is green, and the background color is green, telling us that we, of course, have a bullish posture as well. So that's one storyline. The other storyline is really what's going on with the NASDAQ. Now, I mentioned Facebook, and of course, Facebook is highly influential on the tech-heavy NASDAQ, and so no surprise at all to see the NASDAQ composite down over 1% today. Maybe what was a surprise, at least to me, was the fact that the damage on the chart does not look that bad. You know, you look at this candle right here, and yeah, it's down 1%, and so you pick up a copy of the Wall Street Journal and you see that an index is down 1%. That's a pretty violent day. But you take that into perspective and context of what's been happening recently, and we really just gave back yesterday's gains. You know, yesterday was a huge up day. We gave all that back today. So we're kind of starting over. And if we're starting over with Amazon reporting after hours tonight with a big beat, who knows? Maybe the tech stocks still have some room to run on the upside. What we do know is we have what's known as a bullish intermediate confirmation signal. You'll see that down below here. I actually answered a question from fellow market scholar Richard in my question and answer session here about an hour ago that many of you attend on Thursdays regarding this particular trade setup here as well. So remember, for those of you that are premium scholars, make sure you're joining David and I's question and answer questions if you have our classes if you have questions for us. But anyway, this bullish intermediate confirmation signal exists because we have a bullish intermediate term line, which happens to be in the upper reversal zone right now in the NASDAQ, combined with the red line in the lower reversal zone. So that is the kind of two-part series that makes up the bullish intermediate confirmation signal. Now you will hear us reference this near-term blue line here as well. That is not technically part of the signal, but what we've noticed over time is that the signal usually plays out a little bit better if that blue line is positioned between 50 and 20. So this is a bullish intermediate confirmation signal. It may not be considered an ideal one. So, you know, maybe we have another couple days of a pullback, but at least we still know that despite that terrible price action out of Facebook, it didn't destroy the entire stock market. So there's some reason for hope out there. Let's go ahead and take a look at our next chart setup. We'll do a chart for C this time and talk about our three green arrows. So notice that this particular chart setup is going to show the same four indices in the United States. It's going to look at a 3-month time period. Each one of the candles is 1 day in length. Where the charts are different is that on this setup, this is chart 4C for those of you following along at home, this particular chart is going to show you what's known as a 3 green arrows setup. And the 3 green arrows setup is basically looking at 3 technical indicators. You're looking at your 30-day moving average, your MACD, and your stochastics. And 3 green arrows is just a way to say all of those signs are bullish right now in according to how you would interpret them. And so when you see the background color change to a green color, that means that we have 3 green arrows. When you see a pink background color in this setup, it's 3 red arrows. And if you ever see a white background color, it would be a mix of those green and red arrows. So as an example, with the S&P 500 over here, you saw this white patch here. So that was when we had a mix because we still had the green arrow on the moving average, but we had a red arrow on the MACD and the stochastics. So anyway, where we stand right now is 3 green arrows on 3 out of the 4 indices. We've got that on the S&P 500, we've got that on the Dow Jones, and we still have that on the NASDAQ despite the Facebook problem there. And where we don't have it is the Russell 2000. But it really wouldn't take much. Now we still have that green arrow on the moving average, but we are working through these red arrows on the MACD and the stochastics. But as I mentioned before, this doesn't look terrible. We're bouncing off of a rising moving average. If that kind of bursts a little bit higher for the next couple of days, we might very well be back into a 3 green arrow situation on the Russell 2000 as well. So on a day that could have been really ugly, considering the Facebook situation, we actually are retaining strength much better than a lot of folks would have assumed. So things are looking reasonably strong at this level. Let's take a look here now at our next 4 grid, and this will be our 1040 crossover method. Now these charts will tackle the same 4 indices, but the time period is different. These are 3 years in length. The aggregation period is different. These are weekly candles rather than daily. And what we're looking at here in terms of the background colors of the charts here on 4D is if it's green, it means that we have a bullish crossover on the 1040 crossover method. Now, the 1040 crossover method is just a way to apply moving averages and seeing when those moving averages cross one another, with the idea being that the less or the more sensitive moving average should move up and through the less sensitive moving average if you want to be bullish. Now, of course, that happened about 2 years ago in all 4 of these charts' cases. So we've been bullish from the long term that entire time. What we didn't know is whether we would be going bearish in some of them here in the reasonably near term. But as I mentioned before, our problem child there was the Dow Jones Industrial Average. And you can see prices came down and actually touched that 40-period exponential moving average. But the orange line did not cross the blue line. And that's what we're looking for in order to then see a green background switch to a pink background. And with today's price action on the Dow, as I mentioned, you know, you could really say that the Dow probably looks like the strongest index right at this exact moment. And so that's a good sign because it kind of try to pull that orange line away from that blue line again. You can actually see that down below here. with the MACD2 line. Remember, this is basically tracking the distance between the orange and the blue line. So when you see it curl higher again, like it does right here at the end, it just basically means that that orange line is getting further away from that blue line, and that would be viewed as bullish in this particular context. Let's now do some 12 grid analysis. Starting with the intermarket analysis 12 grid here, you can see that the VIX was down. Again, a bit of a surprise. I don't think I would have gone on record saying that the VIX would be down on a day when Facebook was down 20%, but that's why they play the game. And so VIX remains very low. There's not a tremendous amount of fear in the system right now if you're taking your cues from that. Now you're noticing that we have a mix of green and red charts here. Remember, the green charts would be considered bullish according to the market forecast intermediate term line. The red charts would be considered bearish. What I'm typically looking for here is kind of continuations of trends or perhaps reversals of trends. And so it's been a bit of a mixed bag here, quite honestly, in terms of that with the intermarket analysis. One area that I have been watching is the US dollar. That's a very important asset for a lot of reasons. But you will notice that despite it retaining its bearish posture, that's why the background color is pink, we actually did have a nice bounce back day out of the UUP. Remember, that's just an ETF or an ETN that tracks the US dollar versus a basket of other securities or other currencies, I should say. But it basically gives us some good insight as far as what's going on with the dollar. And you can see it's a nice little bounce higher. And so we'll see where that takes us. I don't think the story has been told with the dollar yet. Yes, we know we've gone on a tremendous rally in the dollar, and some people would just assume that just because we've gone up a lot, now it's time to go down. But remember, sometimes these things take months, if not years, to work themselves out. So I'm not sure I'm in that camp quite yet, but we are watching it very closely because it does impact so many of the other markets that are out there. I mentioned the relationship to commodities. Of course, gold prices were down today because of that rising dollar. We also saw ag commodities down today, partially because of that rising dollar. We did find crude oil kind of bucking the trend there to a degree. Crude oil did finish higher today, and that helps support master limited partnerships. Look at that nice breakout. I mentioned it yesterday because of that really aggressive candle we had yesterday, but today kind of confirms that even greater. Yesterday was a bigger percentage move, but the fact that we just kept on coasting higher today and closed near the high of our candle is a very promising sign there for master limited partnerships as well. So some interesting price action taking place. Let's go ahead and take a look now at our foreign stock markets 12 grid. As we look at this, we can see here that it's a good looking picture. All 12 charts green, meaning that we have bullish postures from an intermediate term perspective on all 12 of these charts. Now, of course, the charts themselves look different, and which ones you pick out for your various strategies are up to you. But from the market forecast perspective, things look a lot better right now for the foreign stock markets than they did about a month ago. As in terms of the prices themselves, I've been kind of pointing out Israel here recently. We had a really nice bounce up day yesterday, kind of similar to the master limited partnerships that we identified in class. But you'll notice right there, we had another breakout higher above this previous resistance area. The problem is that the candle doesn't look all that appealing. You'll notice that it's kind of filled in black down there. And what that's telling us is that we had kind of a gap up to start the day, and then we closed lower than where we opened, but we still closed higher than yesterday's close. So that gets a little bit confusing at times, but there's kind of a mixed message there. Yes, we closed up, and you can see we were up 18 cents on that product, but the problem is we closed lower than today's open, and so you might say that the bears won the end of the day, even though the bulls may have won the war. So the bears won the battle, the bulls are still winning the war. So anyway, things are looking stronger on a daily basis, it seems, here for the foreign markets, and I would say that's a healthy sign in general. Let's now take a look at the U.S. sectors 12 grid. And as we take a look at that here, notice that we have a lot of green on this chart as well. In fact, we only have a couple of holdouts at this point. We have discretionary that just went to a bearish posture in the upper right. We have telecom that had been in a bearish posture down there in the bottom rung. And then in the lower right-hand corner, we have real estate. But you know, real estate's been interesting to me. I'm not willing to write it off quite yet. In fact, this price action is not terrible. It's quite healthy. We've had this series of higher highs and higher lows, and we're still retaining that. So despite having a bearish posture, I'm not sure I'd be the first in line to go take a whole bunch of bearish trades against the real estate stocks right now. You're actually seeing a pretty nice little bounce off that moving average right there. So keep your eye on that one. But otherwise, we've got some good price action out there. We've been talking about healthcare a lot here lately. They were down a touch today, but still closing in the upper half of yesterday's huge candle. We had positive price action out of energy today, up over 1%. Notice that's 3 days in a row to the upside on energy. So all of a sudden they're starting to creep into fashion again. Same thing can be said there for the materials. Remember, those areas can be supported a little bit more if the dollar starts to cool off. And so that is kind of the environment we're in right now. And then you'll see some of the other charts there in front of you as well. Consumer staples had a good day. They were up 0.5%. Of course, technology was down 1.5% because of Facebook. But you heard me mention Hershey's earlier today. And if we go over here and take a look at some of the best performing stocks in the market today, you might be surprised to see that it was actually Hershey's that was up there near the top. So if I go over to the public list and go to the S&P 500 and then kind of sort by percentages here, you'll notice that Hershey's was up 7% today. Now that was almost astronomical in my mind. Many of you know that, in fact, I mentioned it in last night's video, that just on Tuesday I wrote an article for See It Market, kind of talking about the opportunity that exists for long-term investors in Hershey stock, because I anticipated that they would be raising their dividend today, Thursday morning, and I had expected them to raise it between 5 and 10%. They actually came in and raised it at 10%, which was just fantastic. They also beat some of the other numbers that analysts were looking at. So I was very happy to see that didn't end up with egg on my face after I wrote that article. If all the stocks I could write positive articles about could go up 7% the next day, I'd be writing full time. So, but as a reminder, of course, that's not always going to happen. But certainly glad to see it happen that time around. So Hershey's was a big upside surprise winner. Some of the other big winners here today included Advanced Micro Devices, Arconic, DR Horton, Xilinx, Alaska Air, Southwest, then there's Hershey's, and Marathon Petroleum, Qualcomm, Valero, and Endeavor. So kind of a mixed bag there. A lot of them having to do with earnings, as you could probably imagine on a day like today. Of course, we talked about Facebook already, but let's take a look at who some of the other big-time losers were in the S&P 500. So you had Nielsen Holdings that were actually down worse than Facebook. They were down 25% today. Facebook down about 19%. Mohawk down about 17%, and then Synchrony down 10%. Biogen IDEC was down 10% as well. So that probably explains a little bit of what was going on there in the healthcare space. You actually had a line down as well. That's been an interesting company that's done really well in recent months and years as well. So I'll be curious to see where a line starts to kind of bottom out. Maybe there'll be another opportunity for those of you that are growth-oriented traders out there for that one once it stabilizes. Let's talk about, since we're on the subject of earnings, and of course we're still in the heart of earnings season, there's a number of big names that are reporting earnings here tonight as well. So let's maybe go through a couple of them here. I'm going to come back over here to the trade tab, and let's take a peek at some of them that are coming out. I know that Intel came out here tonight. So Intel closed at 52.16, the normal session. They're currently trading below 51. So that looks like a disappointment in Wall Street's eyes for Intel tonight, kind of carrying through with that technology theme that Facebook suffered with last night. We also had Starbucks come out here tonight. And Starbucks is another company that we've actually been talking about quite a bit in my dividend classes. They hiked their dividend dramatically earlier this year, and this number right here is not accurate on the Thinkorswim platform in terms of yield. Their yield is actually closer to 3%. We actually bought Starbucks when it was trading below 48 bucks in one of my dividend growth investing classes a few weeks back, and right at that level, so $48 or less, is where Starbucks has a 3% yield. So it's one that a lot of us have been keeping our eyes on in the dividend growth investing world, because that has not existed up until this point. Starbucks had been traditionally known as more of a growth-oriented company. It may now be entering into its more mature phase as an organization and becoming a higher dividend yielding company. But anyway, they did report their earnings here tonight, and the good news is it didn't plunge. And so there were a lot of concerns with Starbucks, in particular because of the importance of China as a growth market for them. And of course, many of you heard that Qualcomm NXPI deal was called off. We had a good conversation about that in my question and answer class here today as well. But anyway, there's fear that there's growing tensions between China and the United States. And that's really the biggest question mark for Starbucks right now, because they do kind of view that as their golden ticket into the future. And if all of a sudden that is shut down, that's going to be a very rough go of things for Starbucks. But right now you can see the stock is actually trading up after hours, but only by about 15 cents. So not a whole lot of movement there out of Starbucks. And again, remember last night I talked about Visa and the market maker move. Remember, you can see that market maker move up here on the trade tab for those companies, a lot of them that have earnings coming up, because their front month contracts have that higher implied volatility. So market makers were really thinking this would move more than $2. So this would have been an interesting candidate to sell calls or puts on, just sell premium on, because the movement was not as extreme as what Wall Street was anticipating. Let's take a look at a few more companies that came out with earnings. Chipotle came out tonight as well. And so Chipotle actually has been a bit of a surprise story. They've kind of quietly turned things around here. Obviously, they had a rough patch here a few years back, but they're quietly turning things around. And you'll notice they had another nice response to their earnings here tonight. They closed the session at $4.46. And they're now trading a good 25 bucks higher than that, above $470. So that's a good sign. Let's take a look at Expedia now, EXPE. And that's another big beat. Now take a look at this. This stock was trading at 125.80 as we closed the normal session here today. But take a look at that bid price right now. We're way up there, $13 per share higher than that, up at 138. So that's a nice beat out of Expedia. And then lastly, let's take a look at Amazon as well. Of course, that's the big daddy of them all. And there was some fear kind of going into tonight that Amazon would lay an egg the way that Facebook did. Fortunately, that is not the case. And so Amazon is actually up $20 per share as it stands right now. Now remember, this is all early days. There's a lot of time between now and tomorrow morning's open. But we knew by this time yesterday that Facebook was going to get hammered. The good news is Amazon is actually a positive response to the upside. They crushed the analysts' expectations in terms of an earnings number, and that stock is trading up almost $20 per share after hours here. Now remember, on an $1,800 stock, that's not a very dramatic movement, but nonetheless, it's good to see that that thing did not get flattened after hours. So that should help the market stabilize to a degree after having some of those fears. You know, a lot of people think of Amazon in a lot of the same lights as Facebook, just simply because they're both part of that FANG acronym. So anyway, good sign there out of Amazon. Let's now talk about our trade application example for the day. So I'm going to come on over here to charts. I'm just going to go over to chart 4A in this case, and we're going to take a look at IWM. And I mentioned that IWM does have mixed signals right now. It has a bearish posture according to the market forecast intermediate term line, and that's why we have that green line kind of pointing lower, as you can see down below here, and the background color behind the candles is pink. It's telling us that, yes, we do have a weekly bearish posture. Now I stress weekly because notice over here during this time period we had a strongly bearish posture. That's when that pink turns into a darker shade. So right now we know that there's a little bit of trouble. It's not a lot of trouble, just a little bit of trouble that has slowed the progress of the IWM chart compared to where it was trading in the past. Now on the other side of the coin, you know, the positive element of the chart is that we have bounced nicely where we expected it to bounce. Remember, we appreciate charts that do what we think they're going to do, because that is not always going to happen. In fact, you're going to be wrong regularly as a trader. So it is good to see that we probably would have anticipated a bounce off of the moving average, and that's exactly what we're getting so far. We'll always see what tomorrow brings, but the point I'm trying to make is you could argue both sides of the coin here when it turns to IWM and the small cap stocks. You can have some people in the bearish camp, some people in the bullish camp. A lot of you are going to look at that chart and just say, isn't that just sideways? And so when you have a lot of those different mixed signals and a sideways looking chart, of course, one of the strategies that can take advantage of that, as long as that continues into the future, is an iron condor. And so that's what I thought we would practice in tonight's trade application example. So for that, let's go over here to the trade tab itself. And I'm going to come over here to the various strikes that are available. Now in this case, I'm actually going to go over here to the August weekly contracts with 29 days until expiration. So let me open those up here. And I'm going to close down the monthlies. Now remember, a lot of times I will stick with the monthly contracts, especially with a multi-legged strategy like an iron condor that has 4 different strikes. But with IWM being one of the most liquid instruments on planet Earth, this is an area where going into the weeklies is not that big of a disadvantage. So in this case, I'm just going to choose to sell a little bit more time. We usually like to sell about 30 days if we can get it and see what we can come up with here. So with that, let's go ahead and start structuring our iron condor trade. And for those of you that haven't done this type of a trade before, it's effectively a trade where we're selling credits on both the upside of price and downside of price, with the hopes that that instrument just goes sideways from here through expiration day. So let's see if that can work out for us here today. So what I'm going to do is I'm actually going to expand the strikes a bit more. Remember, because IWM is such a popular offering, sometimes you have to expand your strikes a bit more to see the strikes that you might actually want to trade. And typically when we're doing an iron condor, we're going to sell a 20 delta on each side as our starting point or our driving part of the trade. So we're going to sell the 163s in this case because that's our 20 delta on the put side. And I'm going to do a $2 wide. So let me right click. I'm going to sell on paper money here to iron condor and then clicking on iron condor right there. That loads up our trade down below. Now remember, we have to make some manual adjustments down here because there's so many strikes. So in this particular case, I do want the 163 put to stay put. But in the case of the 162.50 that they load up by default right below it, I do want to change that to 161 to get the $2 wide between those two strikes right there. So we're selling the 163 put. We're buying the 161. On the other side of the coin, so on the call side, we're going to come back here to the strikes. And again, we're going to search for a 20 delta. And in this case, we see that a 20 delta on the call side, which will be on the left-hand side here, will lead us to the 173. So on that, I'm going to come down here, change to 173 on the call. So I'm just hitting this drop down, going to 173, and then we're going to buy the 175. Remember, when we're doing the call side, we need to buy the strike that's the higher number. That's kind of our built-in hedge, just like the 161 put is our built-in hedge on the downside in case we're just flat out wrong with our analysis here. So in this particular case, we have our trade loaded up here, and we get a 55-cent credit for taking this trade. Now remember, this doesn't have a whole lot of implied volatility. This is kind of a quieter instrument here. So you're not going to get a huge amount of credit out of this, but what it can do is, again, take advantage of a situation where a chart is just simply going sideways, where you have kind of controversy between the bulls and the bears, and they're just kind of working out their problems in the middle of the chart. So as long as this instrument, which is trading at 168.40 right now, stays between 163 on the low side and 173 on the top side, so we have a nice $10 range to be correct there, then we should be in good shape on this particular trade. If it goes a lot further than that, if it bursts way back past 175 on the upside or bursts way down below 161 on the downside, then we've got those protective measures embedded into our trade itself. We'll still lose money, so I don't want to give the impression that we would make money if that were to occur, but we won't lose incremental amounts of money, and that's the whole reason you structure the trade that we do like we do right there. So anyway, we got a $10 kind of cushion, $5 up, $5 down, where we can be wrong on this for the next 29 days. And as long as there's not an aggressive move, we can win this trade. So I'm going to confirm and send that. We'll ship that off to the market and see how we do on it. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. Of course, Dave is going to be out of the office for the rest of the week, so I'll be with you tomorrow as well. Remember, if you get value out of these videos on a daily basis, there's a number of things that you can do to help David and I along with that and help us recognize that, which is you can like and retweet these posts on Twitter for us. You can also like it on Facebook and like it on our blog. In fact, we make it nice and easy for those of you that actually watch this on our blog to do that all in one place. So we appreciate your support with this product. We wish you the best with your trades and your investments, and I'll look forward to coming back with you tomorrow. Take care, everybody. Bye-bye.